2023 tax season is here, and in 2024, cryptocurrency is the talk of the town. It's not surprising considering since October of 2023, Bitcoin has surged, reaching levels up to $50,000 per Bitcoin. Of course, other forms of digital assets and currencies have also seen some explosive growth throughout the last couple of months. Now the question is it going to continue going up? I don't know. I don't think anybody really knows. But in this video, we're going to talk about what is certain, the taxes surrounding cryptocurrency. In this video, we're going to talk about how cryptocurrency is taxed and cover all of the different scenarios in which cryptocurrency meets taxes. Now, in 2014, the IRS deemed that cryptocurrency, also known as digital assets, should be considered as property for tax purposes, which means that they are subject to capital gains tax. Now, the good news is that buying cryptocurrency with cash is not a taxable event. When individuals receive crypto as a payment for goods or services, it generates a taxable income for the recipient, which is taxed at ordinary income rates. The recipient's taxable income is equal to the fair market value of the crypto at the time he or she receives it. Now, selling crypto for cash is a taxable event, giving rise to a potential capital gain or capital loss. Similar to a stock or a bond or any other capital asset that we know and love, the amount of time that you actually hold the crypto also affects your tax liability. So for example, if you've held it for more than a year before selling it or exchanging it, you'll classify any resulting gain as a long-term capital gain rather than a short-term or under a year ordinary income rate. Now you can calculate the gain or loss by finding the difference between the selling price and the fair market value at which you initially purchased that asset or that cryptocurrency. So let's see this in practice in a potentially real-world scenario. Let's say contractor A performs a service for company A, B, and C. And on November 30th of 2023, company A, B, and C pays contractor A 1 Bitcoin. Contractor A holds that Bitcoin until she decides to sell it in February 10th of 2024 for about $39,000 in cash. Now, when she received the Bitcoin on November 30th, its fair market value was $37,000. So two things happen here. The first taxable event occurred in 2023 when she received payment for her services. Then on her 2023 tax return, contractor A would report $37,000 of ordinary income. The second taxable event occurs on the sale date. So for her 2024 tax return, contractor A would report $2,000 of short-term, under a year capital gains. Receiving cryptocurrency as income or in the form of capital gains or losses is not the only way for a taxable event to occur. Say you wanted to use Bitcoin or cryptocurrency to purchase an asset, let's say a car, for example. So in the case of contractor A, instead of recognizing that sale and using that cryptocurrency value to buy cash, she would have bought a car that was worth $39,000. Now, of course, you pay the taxes and whatever fees that are associated with purchasing a car, but she would still have to report the $2,000 of short-term capital gain, regardless of what other asset she is buying. Now, another very, very overlooked form of cryptocurrency activity is mining. And yes, mining does create a taxable event. And to grossly oversimplify what mining is, essentially it's the process of creating cryptocurrency using strong computing power. It's a whole operation and we can talk about it at a later date, but ultimately tax authorities apply ordinary rates to tax the value of the mined coins. Another activity that is often popular in crypto is staking. And staking is, of course, a taxable event. Staking is ultimately the process of providing and thus temporarily locking up your cryptocurrency you own in order to support the blockchain validation process. Sounds very technical, but ultimately in exchange, you receive a payment, which is similar to interest, like you would get at a CD or a note. All right, so the examples that I gave before are relatively easy and rather simple, but think about all of the people that receive bi-weekly, monthly, or quarterly compensation in form of cryptocurrency, or perhaps people that are actively trading cryptocurrency very frequently. Well, it becomes a little bit more complicated. And yes, there are some software that is available to track this information, and some crypto trading platforms do offer this information and this tracking capacity. And if you do not receive a tax form from a crypto trading exchange or platform, but you sold or exchanged crypto during the year, You are ultimately responsible for gathering the information needed to calculate and report your taxable gain or your loss. Now, you can report the capital gains or losses on Form 8949, the same tax form that you would use for reporting capital gains or losses on stocks or bonds or any other form of capital assets as well. With the detail and the complexity involved in calculating any tax liability resulting from crypto transactions, it may make sense to work with a tax professional who understands digital assets. Some things that you can do right now are keeping detailed records that can also help you comply with reporting requirements. Now, here our experts at My.CPA are ready to provide any sort of personalized advice for your specific tax situation. You can visit our website to get more information about our services and to schedule a consultation. Guys, I hope you found this video informative and entertaining. You can check out the many different videos that we have over here. And as always, take care.